Evening and welcome to Heritage University's Budget Basics. We are so glad that you are joining us this evening. If you have not had the chance to meet me before, my name is Melissa Rogers and I'm the Vice President of Business Development for Heritage Property Management. And tonight, I will be joined by our very own Vice President of Accounting, Sheron Moshell, and we are going to be reviewing all things budgets. So while we will be speaking about community-related specific topics, we encourage each of you to reach out to your association's attorney should you have any specific questions about your communities participating in any of the items we speak about today. This class is meant for pure educational enjoyment and budget assistance only. Each of you are free to submit questions in the Q&A section, which is located in the upper right-hand corner of your screen. Questions will be answered at the end of our presentation, but please don't hesitate to put your questions in the chat as you have them. We will go through them at the end. If this is your first time attending one of our Heritage University classes, we are so happy that you've joined us. Heritage University offers plenty of classes throughout the year. And what's great about these classes is that they are completely complimentary. You don't have to be a Heritage client in order to participate, nor do you have to be a board member. We are so grateful again that you are joining us. All of these resources will be provided to you at the end, or tomorrow, I should say, after the recording and production has been completed. Any of the items that we talk about or any of the additional materials we speak about will also be included. So thank you again for joining us. And now I turn it over to Sheron Moshell.
Thank you, Melissa. My name is Sheron Moshell, and I run the accounting department at Heritage. We're made up, in case you're not aware, of about 20 folks in accounting, consisting of accounts receivable and accounts payable and financial accountants, property accountants. And each of your associations is assigned a property accountant. So I mentioned this up front because thinking about it going forward, you can always ask your property accountant for help in doing your budget as well as with the property manager. They're very familiar because they're the ones that actually do your financials for you. So just keep that in mind, make notes, and you can always access that extra resource. So I'm going to start off with the next slide. Oh, so what is a budget and why do we even need one? All right, we're just an association. We're just a homeowners association. I looked it up and got the actual dictionary definition of a budget. And a budget is an estimation of revenue and expenses over a specified future period of time and is utilized by governments, businesses, and individuals. If you'll note, I underlined and I wanted to emphasize estimation. It's not something that we look at in stone. It's a plan. A budget basically is a spending plan for a defined period, normally a year, and is known to greatly enhance the success of any financial undertaking. Having a budget keeps your spending in check and makes sure your savings are on track for future purchases. If you think of it this way in your own personal financials, if you were to get your paycheck one time in the beginning of the year in January and you got paid for the whole entire year, you know you're going to have to budget and plan. You can't take your whole annual paycheck and go spend it. So this is why it's so important to have a budget for your association and why we need one. It's for a plan. Next. So common association financial issues to avoid. Underfunding. This is what we run into when we don't have a good plan, a long-term plan. Homeowners don't understand all the obligations if it's not communicated and budgeted and planned and explained. High delinquencies, we're going to talk a lot about this later, but high delinquencies really can derail your financial plan. Board members getting confused by all financial issues and sometimes overcomplicating issues. Our business is very simple. I wanted to emphasize that we are on a cash basis. We count money coming in and we record money going out. So hopefully your plan has some left over that you put into savings. Board members are actually not doing the association justice when they penny pinch too much. So this is another issue. Next. So many of you probably out there to this evening are on the role, have the role of the treasurer. Okay, that is basically the person that's going to be coordinating and setting up these financial goals and the budget. Could be in conjunction with the other members on the board, but mostly it's the treasurer that does this. They help and develop, manage written policies. They coordinate all the cash. They monitor the association's goals and the budget plans with actuals. They ensure that the association does its business the right way and is very conscientious of what's going on and is aware of the spend. You know, the other role of the treasurer is to ensure that the other board members understand the financial situation and the information. Next. All right, so treasurer, you should be able to answer these type questions. Do we have good financial processes and systems in place? Are the homeowners paying their assessments? Again, we're going to be talking about this in detail. Are we paying our bills on time? Are we getting good value and not overpaying? Do we have a good budget and are we on track? Do we have money for an emergency? That's part of the plan. And are we saving sufficient money for long-term replacements? These are the type of things that you want to look at. Next. So let's talk about 4 keys of successful management. Managing your revenue collections. Again, I think this is the 3rd or 4th time I've talked about the delinquency. That is your major effort, should be managing your delinquencies. Effectively managing the cash position. That's part of managing the delinquencies as well. Do we have enough money to meet all of our terms, short-term obligations and pay our bills? Setting financial goals and measuring the performance of these goals. And meeting the fiduciary responsibility of the association. Acting in the best interest. Are we doing business the right way? You are a business. You have a corporate tax ID. We do a tax return and report it to the IRS. So typically businesses do business with other businesses. So we document in accounting. We want to document and have all types of support for everything that comes through on your financials. Next. Revenue, assessments revenue. The homeowner assessments are the biggest and most important source of income. Basically, it's the only income. There could be associations that get a few little amounts on late fees and interest, and you could get an initiation, but those type of things are not designed to run your company. You may get some money for a cable that's coming through the property. Those are not planned to be able to support the expenses. Your assessments have to support the expenses of your community. The assessments pay, for example, common expenses like the roads, the streets, the services, utilities, pools, tennis courts, all those type of things. Determining that annual assessment that the homeowner is paying is important to consider what funds are required. So that's part of that plan. That's what we have to do with that budget. There should always be 2 funds. We have an operating fund and reserve fund. Reserve fund is nothing but a savings fund for future expenditures. Special assessments are also an option for dealing with maybe some revenue shortages or some special projects that you have going on. But they're not a way to have a dependency on your regular common monthly expenses. So when billing homeowners their dues, it is important to make sure that their billing is easy and they totally understand why they're having to pay and why they have this obligation. Next. Reserve goals. Communities set goals for amounts of money to be funded into the reserves. This is part of your budget. You need to plan on savings. The best practice is have an updated reserve study. You don't know when you're going to have to resurface the tennis courts until you probably have a study, unless you've got potholes in it and you know it's time. The absence of reserve study is very important, because you should have a ballpark amount in reserves equal to at least 1 year's assessments if you have no reserve study at all. But the reserve study helps you with that plan. If possible, communities should set a goal for short-term emergency. Definitely. I've seen a lot of that lately. 2 months of operating expenses is what we set as a goal to have as your emergency fund. Next. Reserve study. Again, I want to emphasize the importance of the reserve study. This is a report that is done on your community. It's usually done about every 5 years. The first one is probably cost anywhere from $2,000 to $5,000. They do a complete inventory of all the assessments at your facilities, the grounds, all the equipment, everything that has a cost to replace. They do it as a future life. So you have to plan to put money aside for these type of expenditures. And it could be a short-term goal that you have to replace something in a couple of years, or it could be a long-term goal to replace something in 10, 15 years. Funding is important to provide for those type of expenditures. So fund savings plan provides alternative savings to have money when it's needed. The annual budget contributions, money is set aside out of the homeowner's assessments to go into this reserves. Next. Okay, here's the problems. Association annual budgets, the budget problems. We don't want to see any of this. That's why we're doing this training. Homeowners do not want dues to increase. Oh my goodness, we come up with a budget, we have all these expenditures, and we're not collecting enough money to pay for it. Oh my goodness, the homeowners do not want dues to increase. Well, something's got to give. Part of that is the education of the homeowners of what you're actually having to spend, and that comes along with that plan. So many budgets omit contributions to reserve funds. Again, we were talking about putting money away for savings. Many budgets assume there's no delinquencies. I don't know, or there are very few associations that actually collect 100% of all of their assessments. So you do need to plan for a small amount of delinquency, of uncollected. You would not want to budget for 100% and then only collect, 92%. So you have to budget for what you realistically think you're going to collect. The importance of the communicating the budget to the homeowners is very, very, very important. So why are annual budgets important? Well, we've already mentioned a lot of those items before, but nonprofits require a budget. Don't know if you realize that. Associations actually tend to be weak. We have associations that run out of money by October. That's not good. They have to plan. Guess what? Nothing happens without money. If there's no money and the assessments aren't coming in, then you can't support your association. Cash gives associations the flexibility to maintain and improve their value. Next. All right. I am going to turn it over to Miss Melissa, and she is going to get into the nuts and bolts of actually putting together the budget.
Hello again, everybody. Thank you. Sheron, you added some very incredible comments. And of course, no one wants to be that board member, especially that first board that raises the assessments. Don't you worry about that. We've got you covered, and we've got some good ideas and resources for any of you in the audience today that are expressing or potentially planning for something like that. So let's talk about the role of the budget. We've kind of talked about the treasurer. Now let's set some expectations for those of you who know Heritage and our 27 fundamentals or our Heritage way. This next section is really going to be about setting expectations for you, our board members, and actually for our community managers and our property accountants like Sheron spoke about earlier. We actually gave this exact same education to our community managers last month. And as you know, we are in budget season. And so it's very important to understand who's responsible for doing what and at what time. So let's take a look. The manager is going to collect all of the information, possibly bring in your reserve study, and they're going to make the initial draft for the association treasurer to review. It is then the treasurer's responsibility to take that budget to the board of directors and communicate amongst themselves any changes, additions, or deletions from the manager's edit, if you do have a manager, or from the treasurer's initial edit for those of you that are self-managed potentially. It's then your responsibility to bring it to the board where you're going to review everything, consider committee suggestions. So if you've got a lot of committees in your community and you've got chairs that are coming to you with budget plans, it is a good time for you to go ahead and take those into consideration as well. And it is the board of directors. In 90% of associations, in 90%, the board of directors approve the budget for the association. Now, I will tell you there are only very few that I have seen in my time, but there are some associations that do require the association membership to vote or approve the budget. But most of your governing documents, and I want to be very clear about this, most of your governing documents, and definitely check this, say to disprove the budget, there is a vote of the ownership. And that means that it's the board's responsibility to approve the budget and then send it out to the ownership in its proper timing. Next, please. So now we're going to talk about budgetary preparation. So now we know the who's, the what's, and the whys, and who's going to be doing what, and why it's important to understand the process. Now we're going to talk about the tools that are needed when you come to the table to actually do the budget. So this is what our managers do. Again, for those self-managed associations, this is a fantastic checklist for you and maybe your finance committee, if you have one of those as well. This can be a great addition to some of your training resources, but definitely get year-end from last year's budget, actuals and expenditures. Take a look at your capital reserve expenditures as well. We always take a look at vendor contracts and utilities, any increases. And I do want to touch on this just because it's a very sensitive topic. It is such a great idea to always bid out your contracts. You have a fiduciary responsibility to do that on a frequency that's probably not determined in your declaration, but it might be for some associations. But it is a good idea, period, for you to go ahead and bid out contracts. And right now, what we are typically seeing from association boards is once the manager starts doing the first draft of the budget, the board automatically wants to go ahead and put everything out to bid all at the same time so that they can make sure that they can get the best monthly rate. It's not necessarily the best business practice that we would recommend. It's very important to have those strategic business plans, and we're going to be talking about that here in a second, because having a plan is going to help you understand when the appropriate time is to bid out those vendor contracts so that you can have good budgetary figures going into the next year. Each new year's community business plan, just as we had talked about, economic and inflation factors, let's be honest, we are seeing some very hefty inflation everywhere all the time since the pandemic. For those of you who are very concerned about potentially putting increases in your budget this year, I sincerely suggest you take our advisement when we say plan on at least a 3 to 5% cost of living increase alone. That is not including some of the labor, maybe some of your landscaping contracts that have increased, and we'll talk about those things here in just a moment as well. Obviously, the association's experience with delinquencies, just like Sheron alluded to earlier, you need to know what your delinquencies are, and you need to budget appropriately for that income. It is not a problem to show the association that you're anticipating, because last year you might have had 4% delinquency, that you're also going to add in 4% or maybe even 5% or even 3% to next year's budget, because you know that you do have small delinquency. That's full transparency, and that actually makes your budget figures on variance month to month or from the year a little bit easier for everybody to read as well. And then we're going to talk about the reserves. I understand that a lot of people are penny pinching right now because of the economic inflation that we're talking about. But I can definitely tell you, putting money in your reserves should not be the thing that you chintz on doing this year. Meaning, I know you're probably doing everything that you can to reduce as many expenses, and maybe some of you are deferring projects or maybe even deferring maintenance as a result of it. I understand that portion, but you still need to be feeding your reserves with money, because that fix, that repair, that replacement, that is going to happen. It's inevitable, and you need to be prepared for your association. Can help eliminate special or specific assessments as well. And then, of course, the expected capital expenditures, just as we were talking about. It's very important to know. This is why that business plan is so important, especially if you're working with a lot of committees or you're working with a management company. Your community manager needs to know what your vision is, okay? There needs to be harmony when we communicate to the association the reasons why we might have to increase the budget this year, or the reasons why we're not going to increase the budget because we've had this win and we've been successful in celebrating this. So just keep all of those things in mind. This next slide is my favorite. This is definitely setting expectations. Go ahead and next slide. This right here, these are real dates, folks. This is something that, again, we've shared with your community managers, and I really want to harp on this slide. And if you hear nothing in this educational offering, I really just want you to hear this one slide. Budgets traditionally are about a 6-month process. Now, I know that not everybody is set to the fiscal calendar year. We do have some associations that have June to July. We have some that are April to March. We have some that are September to October. Those are a little bit more rare, but predominantly most associations in the United States, period, or even just the state of Georgia, all have their requirements somewhere in their declaration that they have to have the budget out 30 days prior to the time that it is effective, which for more than likely most of you is December 1st. Well, as you can see, what we've done in this graph right here is we've worked backwards so that you can have a healthy expectation as we see these times throughout the year. So we know that the budget's due January 1st and the ownership needs to have it so that it takes effect. So December 1st is when probably most of your association declarations outline this requirement of the 30 days as we spoke about. But October 29th, now here's a new one for you. The budget must be turned in. If you are a Heritage client, the budget must be turned into your community manager, approved and ready to go no later than the 29th of October. We prefer October 15th as much as possible, as you see. Submit the final draft to the board and hopefully have it approved by October 15th. But if you do need a little extra time for the deliberation or any changes, October 29th is the end all be all. And the reason why I say that is a couple of fold traditional items. We've got Thanksgiving, we've got Christmas and Black Friday shopping. We know everybody loves Amazon because they make things in our lives so easy. But the mail gets jammed up at that time period. And again, as I indicated, 95% of the state of Georgia actually has the same requirements that your association has. So you're not the only one that's also trying to get your statements out or the notice to your association for your annual meeting even. And some of you might even have to do a little bit more due diligence and plan your annual meeting notice surrounding when your budget is due, because you might have requirements that blend in both of those areas. So it's very important to read your governing documents as we talked about. So now as we continue moving backwards, we're now looking into September 17th. This is a deadline to our community managers. This is an expectation that we are setting for you, our Heritage clients, that you can have this from your manager by this drop dead date. And the reason why is everything that we've just discussed. We need ample time to put it into Vanica. We then need ample time to send it to BB&T so that they can load it in their system to send out the coupons as well. So there are certain stages that happen behind the scenes that, of course, we don't expect you all to know, but we give you these little gems, I think, of suggestion so that you can be prepared and you can plan ahead. So September 17th, your manager needs to have your first draft submitted to you. As we said, our community managers have already had our budget education in July. And as you see, we have collected some data. We actually did a full day in-house, which was wonderful because it was probably the first time that we were all really able to see each other post-pandemic. And so we buddied up together. We talked about things. We answered some questions about inflation, and insurance is going to be a really big one. I sincerely suggest, at least 10%, even if you don't have a loss run history. There is just a lot of inflation that is transpiring, and it's completely out of your control. And one of the things that you want to be very careful to do when you're negotiating contracts is your association's reputation is not just solely related to your homeowners, actually more related to the vendors that you do business with. And the more you flip your vendors and the more you have turnover and the more that you've got issues, you might be presenting a poor reputation where potentially some companies might choose to decline accepting a request for proposal from you. So These are some gentle things to just keep in mind, but these are very, very healthy expectations. And as you see there in yellow at the bottom, that's a note specifically for our cans. And just so you know, all of our community managers have this individual slide hanging from their desk or specifically positioned so that they've got that information, because they know that these deadlines are important. So we certainly request everybody's assistance when we ask for specific deadlines. These are the reasons why. We truly, truly, truly want to set you up for success. And we have found this to be a very trusted program. We've done this several years in a row now, and it has been excellent for our clients and for some of our self-managed friends. Next, please. All right, so we've been talking about this simple sample business plan, and look, it doesn't even have to be anything more than a couple of lines, just like these. Hey, we have an intention to do this. It might be on the table that we discuss this topic. We might go out for bid for landscaping this year. We might need to consider creating an ad hoc committee for that. Hey, we are going to target our delinquency that's currently at 20%, and we're going to make our new target 9% because we instituted a new portion in our collection policy that has been very fruitful for the association. It's not just talking about the capital expenditures. Now, some of you don't have what I like to call the sexy amenities. Some of you that are watching this may not have a pool or tennis courts or a gated entrance or luxury amenities. Some of you might just only have a front entrance or irrigation that you're responsible for. And heaven forbid, if you're a condo or you're a townhome community, you might actually be responsible for the entire maintenance of the exterior of your community. And many townhome communities fail to plan accordingly for that because they think it's actually a reserve item, of which it's actually should be built into the operating budget. So just points of consideration. Maybe you're looking to institute new behaviors or new communications. Maybe you even have new operations like new committees. This is a fantastic way for you to communicate to your association proactively, and it does give a little bit of accountability, so it takes the guessing and the wear and tear from the 3% of all of our communities that have the most to say or the loudest voices every time that they attend an annual meeting. So it's important to try to be as proactive as possible with your community, because that actually will reduce significantly a lot of that consternation that associations might find difficult. Next slide, please. All right, budget fundamentals. So we get this question a lot as community managers. How do I know the difference between what should go in the expenses for our operating budget versus what's considered a reserve item or a capital improvement item? And, I look at capital improvements, and we choose to use the word capital expenditures because they're not always improvements. Sometimes they are planned and they are part of your reserve study and they are expected. And they might be something completely brand new that you're bringing to your community that you have not done previously. So think of something along these lines. If your community is going to be purchasing something that has a lifespan of longer than 3 years or is more than $10,000, chances are it's going to be a capital improvement item. Now, taking consideration, I'm excluding anything contractually bound. I'm excluding anything that you might have pending in any proposals for large scopes of work. But just think of it, it's not necessarily replacing the pool deck. That's pretty easy for a lot of associations. And some associations even choose to have the repairing of the pool deck be included in their operating budget because technically that's maintenance. It's not an improvement. We're not resetting the life expectancy back to zero. That's another great tool when you're thinking about capital expenditures. If what I'm doing is resetting a roof, a life expectancy back to zero, that's a capital improvement, okay? That is something that also needs to be updated in your reserve study. So Sheron alluded to having the reserve study updated every 2 to 5 years. That is a best business practice and an industry recommendation. For those associations that have a lot of heavy work or you are adding new things, you must update your reserve study every time you reset that life expectancy back to zero. And the reason why is because you're allocating finances to that expenditure that you might have already spent. And you may have accelerated something that was possibly slated for 2025, and now you're available to do it in 2022 instead. That's perfectly acceptable. That's why that business plan is so important for that community, because you as board members, you need to have constructive conversations and understand the difference between these expenses in your operating budget versus your capital. Josh, next slide, please. All right, budget fundamentals. A lot of this is going to be very, very similar to what Sheron has already talked about. Resist the urging not to change assessments from last year. How many of you board members are that way? Well, we changed it last year, and I don't think we should change it this year. Listen, no one likes to have that conversation with the membership. We understand. But it's very important that you all take a look at what the cost of living is right now. I believe the last index had it just over 5%. We haven't seen that in a very long time. So just keep that in mind. We're seeing big inflation on lots of other things as well. So resist the urge to not increase the budget. No, that's probably not a good idea for your association. We sincerely recommend that healthily funded associations start to get their associations anticipating that they can expect a 1 to 3% increase year over year, because they're keeping up with their reserve study, they're keeping up with their community's business plan, and they're healthily funding their reserves appropriately. All right. Get your homeowners used to asking questions on the budget and getting good answers to show them that you worked diligently on the budget. One of my biggest recommendations that I offer in another board class that we teach for Heritage University is, I'm a big proponent when it comes to the budget or your annual meeting season. If you know you're going to have a contentious conversation with the association, if you know you're going to be raising those dues, and it's really going to cause panic, and you're going to have, or maybe even just a conversation that might be contentious, as we talked about earlier, consider having a town hall first. Consider giving them the exposure to hear the information of how you've done things and give them the opportunity to ask questions. Now, no decisions are made in the town hall or a special meeting for those of you that might call it that way. There are no, well, in a special meeting, you can't have a decision, but a town hall, there are no decisions. That is a great way to, again, be proactive with your association and let them know, hey, we want to give you as much time as possible to anticipate that you're going to see at least a $10 increase to your monthly assessments this year because our maintenance fees have gone up for the townhome. Okay, there's nothing wrong with saying that and proposing that to the community. It definitely makes your annual meeting run a lot smoother. So if you've got contentious annual meetings, might I suggest a town hall prior to, if you think that that might be helpful. So provide comments on the budget line for everything that changes. One of the things that you can expect from your community manager, and one of the things that we recommend to every treasurer as well, make notes. Please tell us why you're making the change. It's not just for that particular calendar year. Those notes are incredibly crucial and beneficial if you change management companies, if you have new people that are treasurers year over year, if you have brand new board members. It's a great opportunity for them to have the understanding or some of the history to allow them to have that better guidance in making recommendations to the association. And don't assume that all expenses are going to be annualized. Friends, if you have a contract, they have set figures. Those go in each month. If you have a one-time property tax fee that typically comes to you in the month of August, please do not annualize that on your budget. You're going to have a significant variance that you're going to have to explain the entire year because it was only one time. So be very careful of the annualized versus non-annualized expenses and make sure you try your best to plan for those accordingly. Another suggestion or example, I should say, is your annual meeting notice mailouts. If you're going to be changing your governing documents this year and you know that you have to send that out to the entire association in the month of March, you need to make sure that your printing and production and your supplies for paper and your postage all indicate an inflation in the month of February because you're going to have that mail out prior to March. Does that make sense? We can talk about that if any of you have some questions later on afterwards. And of course, incorporate your community business plan. Do you hear all of the same things that we keep saying over and over and over again? We're not trying to repeat ourselves to be redundant. We're trying to make sure that you have a healthy understanding why these things are important. Next slide, please. All right, reserve fund contributions. Sheron touched on this in an earlier slide, but I really like this just as a slide for some of you treasurers that might just, maybe you want to print this out and hand this over. Obviously, these are some great suggestions for your reserve fund contributions when you have a reserve study. And as I indicated, it's okay for you to shift certain things throughout the years so long as they are not the critical infrastructure items or the high risk items that could be litigious or high liability for the community, okay? Now, what if you don't have a reserve study? Your community is too small. You don't have the sexy amenities like we were talking about. You still really have no idea how much an irrigation replacement costs. Well, that's okay. You are a volunteer. We respect and we appreciate that. And so here's a great suggestion for you if you don't have a reserve study. We talked about this earlier. Try to do your very best to put as much money into reserves as possible, but you should have as many as possible your common area assets that the budget should include a realistic estimate of the objective that you're trying to accomplish. Maybe you have gotten a couple of quotes. Maybe you don't have a reserve study, but you've gone and you've gotten a couple of quotes for some capital improvements. That is a fantastic thing to incorporate in that business plan. That's a great piece of information that might help your other board members as to why it is you are requesting that $10,000 be added to reserve. So don't worry about that. And then, of course, we've talked about this earlier, the emergency fund. I can't stress this enough, and I'm sure a lot of you joining us or watching this probably paid a lot of expenses in 2020 that you were not expecting. You're probably still paying those expenses that you are not expecting or budgeted for in 2021 as well. So make sure, again, We say this for healthily funded associations, but for even those that are stressed with high delinquency, it's very important. It is unfortunate that when you have high delinquency in your community, it actually penalizes the homeowners that are in good standing because they're the ones that have to pay the increases to the assessments. Okay? So when you're taking a look at emergency funds, make sure you have at least 2 months of operating expenses. So that way, you know, hey, if you spend $10,000 a month on all of your expenses from your contracts, make sure you have at least $20,000 in reserves, or potentially extra in your operating account. And the biggest thing that we see that homeowner associations forget to include is their insurance deductibles. Make sure that those are included on your budget every year. Next slide. We're going to make this super simple for you. In the goodie package that all of you get for attending the class, we are including a sample Excel budget for you. It has all of the formulas, so don't freak out if you're not Excel friendly. We do have all of the formulas in there for you to go ahead and play around with and be able to use possibly as a draft for your association. But we want to make it so easy and hopefully simple for you to understand, unless you are a very complex percentage by ownership for your condominium associations. I know you guys are very special and have a little bit more complexity, but for many of the people watching this right now, it's pretty much operational expenses plus your reserve total divided by the total number of homes in your community equals the annual assessment for each homeowner. So as you can see in the example, if we have $45,000 of operating expenses and $5,000 that we're putting to reserves, that's actually $50,000 because we have to add the $5,000 to the 45. And if we have 100 homes, that makes it so simple. We now know that $500 per year is what each association homeowner should have. Now, that's the best way to do it. That's the easiest way for you to also fact check if your association assessments are high enough. Now, clearly, you can take a look at your income statement and see if there are variances or high expenses that were poorly planned for. Those are also going to be things that will help guide you. But we really want to make this process as easy for you as possible. You are a zero-based funding model, period, the end. You are a domestic not-for-profit. And all of the money that you give for your homeowners must be spent or it must be saved. And even when it's saved, it must be spent. Having a reserves account that's got $2 million in it and you're not doing anything with it is not necessarily the best thing that I would want you to be flaunting to the association. That tells me, when I look at your financials, you might have a lot of deferred maintenance. Now, that might not be true if they have $2 million, but what if they have $2,000? Your financials tell a very big story, and we want to make sure that we can set you up for as best success as possible so that it's as easy for you to understand as the volunteer board of directors or committee members, and make it easy for you to explain to your homeowners as well. Next slide. I believe Miss Sheron is going to finish up the remainder of our class. I look forward to hearing some of our questions that we've got.
Okay, so now we've got our budget. What are we supposed to do about it? How do we monitor it? There's three basic. I'm sure that if you're the treasurer and the board anyway, you've seen your statement of revenues and expenses. You're actually reviewing your monthly expenditures and comparing them to your budget. That is absolutely imperative every month that you look at that. But another report that we added this year is the in January, and you may have noticed it, and I'm not sure everybody is familiar with it, is called the Income Forecast Report. This is a great way to see if you are on target with what you're budgeted and what money you've been collecting. I'm going to kind of go over that one in a minute in detail. And again, I cannot emphasize the importance. Review your AR aging. All right, you need to know who's not paying because that is affecting your cash flow. If you cannot collect your assessments, then you're not going to be able to have pay for the expenditures that you need. So those are very important. And when you're getting ready to do the aging, you know, now you can in the portal you can run your own aging report. So be sure and run the up to date. A lot of folks don't realize that the portal and a lot of the reports that you're getting out of the portal are up to date. We upload our payments from BB&T and from Paylease every morning, which is from the night before. And we post manual payments that come into the office same day. So we're pretty up to date. There's nothing in behind. If someone has not paid, then we don't have the money yet. So please emphasize again, review your aging. Next slide, please. Okay, this is your income forecast report. I'm sorry the totals are really small, but what I wanted to kind of, this is a current one for this year. What I wanted to kind of show you is, for example, this January through July, and again, this is in your financial reports today. The January through July are actual expenditures that have run through in Advanced, okay? The August through December are the budgeted numbers. So if you see the column, it says original budget. Here is your budget. This particular association had a budget of $866,745. When you look at the revised total, what that does, it adds what's actual and what is being budgeted, and there's a comparison. If you're looking down the total income, they budgeted $881, and so far, if we were on the same path, spending or collecting the same budget money, we would end up with $893. So this is a very, very good tool, in my opinion, to kind of keep up to see if, to make sure you're not going to end up in October with no money. Next slide, please. I wanted to emphasize on this page here that you can do a quick glance. I'm looking at utilities. Okay, so we've got, it's very hard to budget utilities. You just kind of have to go with your history, right? So you just throw in numbers, you've got your actuals, and you've got your budget numbers. So you can kind of look on the bottom line there, and this is a helpful tool for you for planning for next year as well. In this particular case, you can see they budgeted $249,000 for utilities, and a quick glance, they've only spent about $244,000. So that if we were on the same path of spending the same money for the budget, you can see that it's kind of gone down some. Next slide, please. Same concept here on the maintenance. All right, they budgeted in this particular case $156,934, and they've already spent $160. I've spent more than I've been planning, right? But you cannot, like I've said before in the very, very first slide, all of your budget is a plan. It's an estimated plan of what to spend. You cannot do every single penny. And just because you have an expenditure that's not on the budget, you also want to include that in the identified expenditure and don't just plug it. Oh, we've got money budgeted here, so let's plug it here, even though it's not that type of expenditure. But this is a quick report where you can kind of see, without looking at every single little detail, how well you're doing. Down at the kind of the bottom, you'll see too where this particular association had some capital expenditures, $320,000. We are zero-based budget. What I like to see on the budgets and what should be done is your capital expenditures should be spent from reserves. So in your budget, you want to show that you're transferring from reserves the exact amount of dollar that you're spending on the capital item. So those two figures right there on your budget should equal, because this statement of revenues and expenses, when you're looking at your income statement, that's your operating mostly. You know, that's how your expenditures go through for your normal common expenditures. Next slide, please. All right. So if you'll notice here, the last page on this particular report, you're looking at a quick glance. It's like, oh, I just got my financials. Let me look and see how I've done. All right, we're budgeted, you know, zero-based budget, revised total $8,000. They're ahead of the game. Based on actuals and what the next budget is for the next 5 months, they're ahead of the game. Woohoo, that's good. It can change. Don't get too excited. But if you ever see that number right there negative, ooh, you need to be really tightening your belt and verifying some expenditures coming in. And it's not that it's not going to be negative. And it is, if it is negative right there, that means you're spending cash already in your checkbook, not paid with this year's assessments. Does that make sense, guys? Or you're short on collecting your assessments. So if you see that revised total down there negative, you really need to keep an eye on that. So this is a great report, in my opinion, to look at things in a quick glance.
And Sheron, I just want to add to that last thing that you were speaking about. For some associations who have really high delinquency, showing a negative number on your budget to your ownership sometimes has to happen. There's only so much you, the board of directors, are supposed to support. Allow the data, allow the true transparency of your financials to also help guide maybe some delinquency improvements as well. But Sheron is correct. If there is a negative number there, you need to fix it. But for those associations who have very high delinquency, I have seen it very effective when they have to show to the ownership, it's either this or we are going to have to increase the assessments. Which one? Either way, we're going to have to increase the assessments.
And this report you can show to your to the owners as well.
Yes, absolutely. It doesn't have any details that are privileged that need to be maintained. So, and just so that you are aware, this is a common topic that comes up, especially related to delinquency. You are allowed to post the amount of delinquent owners. You are allowed to post the amount they are delinquent, but you are not allowed to post their names, their addresses, specifically, or any of their contact information. You can only have the number of homes, say 15, and the total number of delinquency is this. That is an acceptable report for you, or a statement that you are able to give to your homeowner. So, Sheron, I think we've got a couple of questions now. We're at the end of our presentation, so feel free. Let's get these questions fired away. All right. The first question. Our annual meeting is in early November. Do we start on the budget earlier than July? If so, do we expect a draft budget from Heritage? Yes. So specifically for you, your community manager more than likely started in June and probably has your budget, if not already completed. So it's likely sitting at the stage with the director. So one of the things that we have before we even send that budget available for the treasurer to review, we do have internal checks and balances as well. So that would be a fantastic question for you to ask your community manager and just see where they are in the process of that. But absolutely, your requirements would be expedited specifically because of your November due date. Good question. Okay. We have another question. Our association normally raises dues after the annual meeting, which takes place before the end of March. How is the best way to communicate the raise in dues and get the coupon book updated for the January payment? Can the coupon book have the raise printed for the month it would take effect if it's later than January? I am going to read that last part one more time because I was following everything and I want to make sure I hear this correctly. Can the coupon book have the raise pre-printed for the month it would take effect if it's later than January? Yes, absolutely. And in fact, this goes, Kevin, this goes specifically to what I was talking about earlier in having possibly that town hall. If you know that there is communication or you have to communicate with your homeowners because your budget takes effect in a different time than your annual meeting, then it might be just a good idea to give them that update as to where you are with the budget. And you definitely should let them know at the annual meeting, hey, you can anticipate an increase. So it might be best that a town hall is good. Anytime, friends, anytime you are increasing the assessments to the ownership, you are required to give them a notice and an explanation as to why. Just an FYI. So a lot of our managers will send the information in the annual meeting packet or the annual meeting mail out. It'll have the notice and it'll also have the notice of increase in there. So work with your community manager who is also working with all of us as well. Let's take a look at your governing document specific dates and work backwards on making sure that we can hit all of your deadlines. But I'm confident that there are some good suggestions for you that will help you.
I wanted to add something to that, Melissa. With our coupons and our statements that we mail out from BB&T, we're allowed to send with that a letter and documentation, which is very important. So we try to include a letter from the board that says, you know, that information. If your increase is in January, you probably wouldn't, or excuse me, in March, you probably wouldn't get your coupon book until right before March, in February. So I'm not sure, actually. I was kind of confused about the question. I'm not sure January coupon books would have the March raise because but we can talk about it later and make sure that we're following along, Kevin, what you're talking about.
All right.
But one of the best ways also is through a letter that goes out with the coupon books. And we're allowed, I don't know, 4 pages, I think, or 2 pages front and back.
Yep. And we normally yes, and we normally mail your budgets out front and back as well, just especially for some of the larger communities that have multiple homes or multiple pages in your budget for that specific reason. So we have another question. Is the emergency fund commingled with the reserve account? I love this question. We meant to talk about this earlier. The answer is no or yes. Because if your emergency fund is actually in your operating budget, then yes, it's not commingled with your reserves. But if your emergency fund is in your reserves, then yes, it can be commingled and you can have a transfer from operating to reserve or from reserves to operating to pay for expenses. And I know, Sheron, did you want to add anything additionally to that as well?
Yes, we do not have a separate account. If you look at your balance sheet, you would have one reserve account. And then in the liability and equity section on your balance sheet, we have the capability of setting up different GLs so that, say you have a reserve 100,000, you could actually have in that, instead of saying one total reserve 100,000, you could actually say reserve 80,000, emergency fund reserve 20. So it kind of identifies, segregates out what the reserves are used for, or how much you were doing that. We have one association that has about 5 different reserves because they want to be sure that the homeowners know that they are saving for roads, and this is how much they're saving for general reserves, and this is how much they're saving for some other capital projects. This is how much. So you have one bank account, but you can identify on your balance sheet, if you choose, multiple buckets for the reserves.
I want to also add to this. In the state of Georgia, unless your bylaws require it, you're not required to explain how you're going to spend your reserve funds. I know that sounds silly because that goes against everything that Sheron was just talking about, but I want to be very clear. The state of Georgia is a very unique state. We know we have a lot of board of directors that have previously served on associations, specifically in Florida, potentially, where there are rules surrounding that. That is not the case here in Georgia. However, it goes to stand with that transparency, and I hope you're getting that theme. As much transparency and proactive activity that you can make with your owners, the better. All right, and it looks like we have another question. We have quite a bit of money in reserves, mostly for replacing the roof in 15 years.
Yay.
Yeah. Should we be investing in the reserve money in mutual funds or a high interest savings account? Currently, it's a regular savings account making practically nothing in interest. Because you are playing with your stakeholders' money, it is not recommended to do any high yielding interest accounts. We recommend CDs are excellent choices, or again, breaking up your reserve accounts, or if you are reaching your FDIC limits, you know, the FDIC limit, 250. Sheron, did it increase? I can't remember.
250.
Okay, so 250. So maybe we'll have a couple of those so that we can increase that for you. But that is a fantastic question that we get a lot. You're responsible for maintaining it. And yes, that actually means that we don't get a lot of return on investment in the savings or the reserve accounts. But there are some great options out there for you that are that yield some good benefit for the association specifically. I'm looking.
They're not real high right now. I just looked up one today, by the way, and it was 0.6 on a CD. So you're not going to get a whole lot anywhere right now.
Exactly. Should conditional income, such as initiation fees for new homeowners, be considered in the budget preparation process as an offset to the annual reserve contribution or the total estimated operating expense? I too, Steve, am glad you asked this question. Yes, it is perfectly acceptable for you to put your anticipated initiation fee income in addition with your assessments. It is absolutely acceptable for you to put your clubhouse income or your key fob income or your social committee income that might be needed so that you can then offset the expenses later down for your social activities. But the biggest recommendation that we do not recommend is we do not recommend that you include any assessment knowledge to include fines or penalties. Now, again, it's important to allocate for your delinquency, but it sends a very poor message to the association when they see you anticipating fine or violation income. That just simply tells the association that you know it's going to happen, so let's go for it anyway. It will be shown and it will be able to be read. We just don't recommend that you put that up front on the income for the association. Did you have anything else to add on that, Sheron?
No, we typically see initiation being transfer to reserves to help build the reserves, as opposed to using, you don't want to get used to using any initiation monies for operating expenses.
And most of your governing documents or your declaration will actually have that requirement. But again, it might be silent, and that's okay too if it is. How long before annual meeting does the budget need to be completed and sent to the homeowner? Well, that depends. It's a great question, but I would have to have your declaration and your bylaws in front of me to answer that specifically. So traditionally we see 30 days. Sometimes it's 10 to 21 if you're a condominium or a POA. You might have that. Sometimes it's up to 60 days. So it's very important that you take a look at that. And as I indicated before, your annual meeting notice and your budget being due to the association might indeed be two completely separate dates, and you must pay attention to that. I've seen a lot of associations mistake those dates, not on purpose, but they just think one coincides with the other. And believe it or not, you need to check both your declaration and any amendments that you might have, as well as your bylaws when you are doing your budget, because there are a lot of things that go back and forth between the two documents. So you want to make sure. Some of your bylaws will actually even require contract terms. So please take a look. Some declarations even have that as well. So please make sure that you get familiarized with your declaration and your bylaws. I know it's not fun reading and it's a whole lot of legalese, but if you do have the opportunity to be paired with professional management and you're one of our partners, just come and talk to us if you've got a question about something. Obviously, we're not lawyers, so we cannot interpret, but we can definitely talk to you about best business or how we've seen other associations run in a similar fashion and give you that advisement that you look for from us. And okay. Next question is, what is it meant by annualized versus non-annualized expenses? I'm glad that you asked that for clarification. So think about annualized expenses as contracts, your utilities such as water, sewer, electricity, your insurance. Those are items that are always, unless and actually insurance is a really good example, because for some associations, you might pay a one lump sum. Other associations may pay a monthly premium. So you just have to take a look and see what those payment arrangements are so that you can tell whether or not it's annualized. Non-annualized items are maybe month specific, where you know it's something that you're going to anticipate. We are going to be replacing the fences in the month of August. I know I can put that maintenance expense inflated in the month of August because I'm anticipating it. I don't have to annualize it, which means dividing the total number by 12 across the entire year. Sometimes expenses have specific times that they hit the budget and they don't need to be spread apart. It does help, again, as I indicated earlier, to better explain variances that you might have within the budget and any additional items related to any cost savings or any increases that you might see. And Sheron, do you have anything else?
I was just going to say a common example that is the pool contract. You know, you don't typically pay for the pool in January, February, March, and normally you'd budget April through August or September. So we see that spread. And sometimes, for example, when you do your tax return, that's a one-time fee, and we see it divided by 12. You're not paying your taxes every month. It's a one-time fee in the month of March. So that's the differences that we like to look at.
That is an excellent addition. And we have actually come to the end of our evening. Thank you so much for staying the extra 15 minutes with us. We've enjoyed all of your questions. And don't forget, all of the questions, all of the special content, and this playback availability is going to be available for each of you that have registered and attended this class. On behalf of Heritage Property Management and Heritage University, I sincerely thank you for attending our class, and I look forward to seeing you next time.